with Jeff Barton, your voice in the mortgage industry. Each week on this program, Jeff and his guests share their expertise, personal anecdotes, and the latest industry news to keep you in the loop. Now, to provide you with insight and help you navigate the consistently changing world of real estate lending, here is your host for the Mortgage Voice, Jeff Barton.
Welcome back, everybody. I'm Jeff Barton, your voice in the mortgage industry. Thanks very much for tuning into the show. Thanks very much for listening each and every week. As you all know who do listen to the show each and every week, we bring to you information about mortgages. This is the Mortgage Voice, after all, and we also talk about real estate and some other things that have to do with decision-making processes that you go through when you're trying to decide what type of loan you want to get. Do you want a refi? Do you want a purchase loan? Are you looking for different kinds of solutions? There are all kinds of different ways to look at loans and what they do. The main thing most people look at is the rate. The rates themselves are terrible. They've been going up for last year anyway, and it looks as if they're going to continue that, although there is some prognostication that as the year progresses, as we see the real estate market cool, as we see the Fed back off of its interest rate hikes, we may see some relief in terms of mortgage rates. But we've been fluctuating between 6.5% to 7% for the past, 6 months or so, and that's kind of where we are today. But before all that, I am Jeff Barton. Thank you for coming to the show. If you want to see this show on a regular basis and you can't get to it on the radio, go to themortgagevoice.com or go to Jeff Barton, the Mortgage Voice, on YouTube. YouTube houses hundreds of shows, as does KCAA website. That's our radio station in the Inland Empire. Hi to everybody out there at KCAA, as well as in the Riverside, San Bernardino, some parts of LA County and Orange County, as well as some parts in Palm Springs. Hi to everybody out there. And again, all these other venues and places where you can see and hear what we do. So we're talking rates, and let's talk a little bit about rates. The 30-year today, almost 7%, is 6.89%. Now, when you consider the way rates are talked about, right, 6%, 6.5%, 7%, but there is so much difference in a payment to you, the borrower. And so I empathize between a 6.5% and a 7% rate. If you stretch that out to 360 payments, it can be hundreds of thousands of dollars, certainly tens of thousands of dollars. So when the interest rate goes up, and when it goes up a certain number of bips, they call them, it will affect more borrowers, making it less affordable for you all out there to go out and find a house that you want to buy, especially since we've seen some house prices fall. Let's get a little bit more into the rates themselves. 6.89, as I said, is the 30-year fixed. 6.28 is the 15-year, 6.53 is FHA, 6.65 is the jumbo rate, and the 5/1 ARM is at 6.86. Now, yields themselves have been falling, but they are still pretty good in terms of the 10-year and the 2-year. That inversion that we talked about, about 18 months ago as being the dreaded precursor to whatever recession will come down the pike. Well, we're still waiting for that recession, and we still got the inverted yield curve, which you really don't hear that much about anymore, whether that particular saying is a misnomer or whether it's true, where it's yet to be determined, so we don't hear about a lot. Anyway, the 2-year is at 4.472%, and the 10-year is at 3.689. Now, we've almost got 75 basis points, or 3/4 of a point difference between the two. Now, that has fluctuated anywhere from 33 basis points all the way up to almost 100 basis points in terms of the spread. The yields themselves on short-term debt should be less than long-term debt. That's just the way it normally works out, because people who invest their money longer should make more money. But that's not the way the treasuries are selling right now. And by the way, since the actual debt limit standoff, or whatever you call it, they came to an agreement, right? And as a result, billions and billions of new debt is being sold at the Treasury. And apparently yesterday it had a pretty good day. Now, when they say it have a pretty good day, how does it affect rates? How does it affect yields? Usually when people are buying into U.S. debt, they're buying a sure thing. And now, if we're looking at the 10-year at 3.68, we're probably looking at the 30-year. I don't have it in front of me. Closer to 4%. 4% on 30-year is still a pretty good deal. If we do see the Fed do a bit of a pause in their rate hikes, which I think everybody's expecting, although I'm not really sure they're going to do that. I still think inflation is out there as the barometer by which you're going to gauge the entire economy, and the entire economy is still chugging along at 1 to 2% GDP growth. We did have a couple of hiccups last year, but we've seen pretty steady, I think 3, maybe 4 quarters in a row, where we've seen growth in this range, 1 to 2%. I think last year we even hit 2.5%. In the third quarter. Was it third quarter or second quarter? Either one. But this is where we are. So we're seeing some pretty good signs that the economy is weathering the storm of continued rate hikes. Inflation stubborn still. They say stubborn, even though it's at 4.7% in terms of year over year. And let's get into that just a little bit. I think I spent some time last week talking about inflation. My own personal belief is when people are greedy, they tend to raise prices just because. I think the excuse that it's inflation and let's blame somebody really hides the fact that if you can raise your particular prices, you're going to. It's not always the products that you're buying in order to turn around into another product to sell have gone up dramatically in price. It isn't that. I think several weeks ago we went through a long list of different items in the economy, actual items that have gone up in regards to inflation. And a couple of things on the list, toys and electronics, have actually gone down. So is it really that inflation is caused by the Fed giving money to everybody during the pandemic? Is that really the cause? Because if you listen in certain areas of the television or whatever you listen to your radio for your news, they will blame it on a certain policy or a certain thing. I think it's just basic greed. Most people who can make more money want to make more money and are going to make it happen by either raising their price or claiming that inflation makes them raise their price. Again, the gas station analogy last week went to the local gas station in Southern California, which is where I live, and it was about $5.50. I'm like, what the heck happened? Barrels of gas are $80 or less or more, give or take. When it was at its height, when inflation was quote unquote 9% and out of control, the cost of gasoline wasn't anything more than that. When did it become a norm to have gasoline prices at $5, $5.50? To me, it just bespeaks what is always, right in front of us. We don't have to go far to say, hey, maybe we don't need to raise the gallon of gas in California that much. We have gas here. We have oil in the ground. We pump our own oil. We have our own oil refineries. It irritates me, and I know anybody else out there who has that, the big gas guzzler, which I like as well as anybody else, go out there, hit the gas pedal, well, you just spent $10, because 2 gallons of gas goes pretty fast in a 442. That's just the way it is. Anyway, let's get right to a little bit other things other than my own personal opinion about inflation and gasoline prices. Home prices increased month to month and year to year unchanged, meaning that last month house prices went up a little bit from the previous month, but in general it has remained unchanged. Now, that was 2 days ago. Today I read that actually house prices have fallen over the past year by a very, very small amount, but they have fallen. In some pockets in Southern California, prices have really fallen. I'm not going to say the percentage because I don't know, but it's significant. And so therefore, if we do get the Fed and their reprise, their actual not raising short-term interest rates, we may see mortgage rates stall out and fall a little bit. And if we see this particular housing information and the housing prices go down a little bit, that's going to be good. And we're going to have a lot more people happy and get out there because they'll feel confident that they can buy a house at a certain price when rates are falling as well as home prices are falling. This is a good thing for the housing market, which is really hurting right now. And anybody out there who is trying to buy a house will know exactly what I'm talking about. Anyway, I'm Jeff Barton. I'm your voice in the mortgage industry. Really appreciate you listening to the show, and we'll be right back.
You're listening to The Mortgage Voice with Jeff Barton. We'll be right back with more in just a moment. For more information on today's topic, email Jeff Barton at info@malibufunding.net. Now, back to The Mortgage Voice with your host, Jeff Barton.
Welcome back, everybody. I'm Jeff Barton, your voice in the mortgage industry. Thanks very much for tuning in to the show. We bring to you each and every week interesting opinions, certainly, especially my rant on why gas prices are so high here in Southern California. And you know what? The psychology in all this is that you have to feel good as a consumer and feel positive about the future if you want to go get a huge loan to buy a house. It's just the way it is. If you don't feel good about either your job or the economy or some other things, it's really going to affect your decision-making process. One of the guys that we go to all the time to ask about what's happening in our business as well as what's also going on in the supply and demand chain is Luke Mankey from Malibu Funding. He joins us again. Luke, how are you?
I'm good, Jeff. I'm good. Thank you for having me back on.
Thank you. Thank you very much. Okay, so we're into this, I guess, difficult market. And I say it's difficult just because prices went up and the competition for loans has really gotten fierce because there's fewer borrowers for about a year now. What's your synopsis of the buyer mindset or the borrower mindset today versus about a year ago?
I think that what I'm seeing, which is just one small sample size, but
right.
I think that you've got people in these metropolitan markets, you know, whether it be like your Seattles, your LAs, Orange counties, where you've got strong economies going, you've got a lot of buyers I have seen that are just, they're going after it. They're not happy with the payment and rate, but they like that there's a little bit less competition. I think there's a little bit less investors and cash buyers in some markets. And so you're still seeing multiples, but I mean, we did a half dozen purchases over the past couple months, and it was, you know, all those buyers, it wasn't their first offer. It was probably their fourth or 15th offer, but they finally got something accepted. And, you know, it's just the inventory thing. We're all a broken record with this, but with such low inventory, the prices are going to remain strong, but at least you've got people that are able to secure some properties and buy and close and get a house. But I don't know. I in other areas and markets, I think that you're seeing the softening, some stuff with what my wife's doing, she's seeing it as well. So, I mean, other industries are definitely struggling. There's layoffs. I've got buyers in Los Angeles that have opted to back off, even though they're about to get an offer accepted because of these writers and director strikes. They're thinking people are going to feel the squeeze there, and maybe there's going to be more inventory, more people that they're forced to sell, and maybe that takes 6 months to surface. So I don't know. Everyone's speculating, trying to figure out what the best when you know.
Interesting. All that I hadn't even considered that would be a possibility. Certainly, there's so many people involved in that entertainment business here in the Los Angeles market, which absolutely stretches to San Bernardino, Riverside, and all over Southern California, where production and people who work in production are and live. And so as that particular strike wears on, and my understanding is the actors and there's somebody else going on strike or voting for the strike next week on the 15th.
Yeah.
So
I think the writers are about to settle and accept, but I think you're right. I think actors, maybe it's the producer. I can't remember.
Yeah, I don't know either. Yeah, I hear about it, but because I'm not in that industry, I mean, our industry, we've already seen the layoffs, and we've already seen this process really take place over the last 6 to 8 months, whereby, you know, cutting people because there's no business is obvious way that you stay in business. But we've seen the mergers and acquisitions. We've seen some failures, obviously, on a national level. But locally, too, we see fewer and fewer people in the business, which is obviously affecting your ability to buy. I mean, if you're not making money in your job, whether it's in the loan business or you're in the entertainment business, that's an issue. And in Southern California, that's a big issue.
Yeah, absolutely.
Products. Tell me about some of the products that we've seen in the marketplace that are successful, that we seem to be gravitating. Are we going back to more conventional market, or are we going forward into the non-QM even more?
I mean, a little bit of both. For me personally, I'm not seeing or doing anything with any new products. I mean, I've heard some some like higher FHA DOE only programs. I haven't closed any. this down payment assistance stuff. They ran out of funding now. I guess they're bringing it back. Again, personally, I haven't closed any of those. I've shopped a few, but nothing materialized. For me, the non-QM stuff, self-employed borrowers, we've closed a couple purchases for people that are like plumbers and electricians. They own their own businesses, and those industries are still pretty strong right now because
yes, they are.
You can't build a home quick enough.
Right.
So those people have options, and heck, we did a 95% loan to value first time home buyer on a plumber, and they were ecstatic to be able to buy something for $600,000. So all that stuff is still there, and it's competitive, and you just tell yourself, look, the payment's 20-30% higher than what it was a year and a half ago, but if you can qualify now, then it'll be gravy in a year or two when you hope that rates are maybe down 1.5%, and then you refi and drop your payments $500, and then you're even happier. I don't know.
I hear that all the time, but and the reverse of that is also true. Maybe in a year or so, it's a point higher in terms of the interest rates. Now you're going to be happy you got the loan you have, because obviously if you try to get in now, it's going to cost you more money.
100%.
Right.
And the difference, like 08, 04, 03, 4, 5, 6, all of us were getting into these things. We were paying high. We all knew it. And we were like, God, but we just were drunk on the equity, but we were all going in 2- and 3-year fixed loans.
Yep.
So, and this was me personally as well. Like my wife and I bought in 05, and then the loan adjusted, and then we had the 08 collapse, and then I lost 40% of my equity, and we had to come in with a bunch of savings to pay down the loan to be able to refinance. Whereas now, your rate sucks, it's high, we're all frustrated at that, but at least you're in a 30-year fixed and you income qualified. You're not going to have this ticking time bomb where your loan adjusts and the rate goes up 2 or 3%, and then you can't afford the payment. That's not happening now. So that's another reason I think to feel, strong enough to want to proceed with buying. If you need to buy and want to buy, then.
Well, there's a bit of a chess game, and I think in any scenario, the actual economy will probably do okay, because, as you said, the loan, they're not doing the 228s, the 327s. They're not doing any of those kind of fixed rate short term and then adjustable either, after 3 years or after 10 years. They're just not doing as many loans like that. And as a matter of fact, if you look at the 5-1 or the 7-1 today, it's priced more than the 30-year fixed, because they don't want you to do those loans.
Absolutely.
It used to be those particular rates on a 5-1 were less, but not anymore. No,
no. It'd be kind of nice to stay where, but I understand why they're not.
No, absolutely. Who wouldn't want to sell a rate at a point less, even if it's a five-year fixed? And then you're just saying, okay, you get into the loan, you get into it. There are 40-year loans now, but I don't know if that lessens. I guess overall it lessens because you're adding 10 years. You're going to pay more at the end, but you're going to lower your payment. And I don't know if you've seen those be popular in your sphere of book of business either.
No, for me personally, I'm aware of a few lenders that are offering them. I haven't closed any. It just hasn't been the type of clientele that's come across my desk that's been referred to me. But it's good to have those options.
I agree. Yeah. Okay. So future, obviously, in looking and prognosticating myself, you read, you say, okay, so let's say the Fed pauses their particular rate hike. It'll help the mortgage interest rate if prices keep falling or remain constant. Obviously, you're going to have a bigger pool of borrowers, which would help the mortgage industry. What's your look at it or take on it?
Yeah, I agree with everything that you said. We even saw, for me personally, things really picked up where we at in June. I want to say in March is when things really started picking up, and in April, rates went down.
Yes, they did.
0.3% or so,
right.
And I think that kind of stoked the fire. So my hope and thought is entering into the summer, we get, the Fed holds the line, we don't raise rates anymore, we get a little bit more of a strong foundation. Whether the rates hold or they trickle down a quarter or 3/8 or something, I think that, it'll hold, but as I say that, I take a deep breath because we need inventory. Still, nobody's refinancing, nor should they be unless they want to take a second or something like that. So it's still a purchase market, and the inventory, so I don't know what.
Prices are going to hold. They're going to remain steady, go up. They have to because there's no product, right? And if you have any kind of demand, which even with a mild recession, which I don't even know if we're going to get that. It's anyway, Luke, we're at the end of it. I appreciate chatting with you here. I don't know if we accomplished anything.
Yeah.
Okay, that's
paralysis by analysis.
Yeah. Well, thanks, Luke. Thanks for coming on. I really appreciate it.
Yeah, likewise, Jeff. Thanks for having me.
Sure. You want to shout out your phone number, let people know how to get in touch with you?
Yeah, if you guys would like to, my phone number direct is 818-209-2592. Thanks again, you guys.
Thank you very much, Luke. And that's Luke Mankey from Malibu Funding. I'm Jeff Barton, your voice in the mortgage industry, and we'll be right back.
You're listening to The Mortgage Voice with Jeff Barton. We'll be right back with more in just a moment. For more information on today's topic, email Jeff Barton at info@malibufunding.net. Now, back to The Mortgage Voice with your host, Jeff Barton.
Welcome back, everybody. I'm Jeff Barton, your voice in the mortgage industry. Thanks very much for tuning into the show, for coming to us, for the advice that you're going to need, whether you're buying or whether you're even selling. I mean, if you're going to sell, are you going to rent, or are you going to go buy something else? You're going to need a mortgage professional to talk to you about your finances and what's the best way that you can take advantage of any real estate market, which is kind of what we're in right now. If you want to hear the show in the traditional sense on the radio, driving around on Saturday or Sunday afternoon, go to KCAA.com. They are our terrific partner in what we do each and every week and have been for years. And if you want to see and hear me there, just go there. They have archived a lot of these shows. We have hundreds and hundreds of shows there. As I said, we've been with them 9 years. KCAA, and you can reach our show every Friday and Saturday. I'm Jeff Barton. This is The Mortgage Voice, and thanks for tuning in. Okay, so we bring, as everyone knows who listens to the show, experts to the show, people who have been in the business a long, long time. This is a very volatile time in the mortgage industry in that we're not quite sure what's happening with rates, inflation, or availability of property. Other than that, we can control everything, even though that is everything. But to help us sort through it is Maggie Miller from Malibu Funding. Been with the show for years and comes back to tell us a little bit about what's happening in her life in the mortgage industry. Maggie, how are you?
Good, Jeff. How are you?
I'm okay. As the description of you as the expert of what's happening in the market, I hope that doesn't make you feel
intimidate me?
Yeah, exactly.
No, not at all. No, nothing can intimidate me.
Excellent. No, you are one of the stronger loan officers that I've seen in forever as a person.
And stronger individual in general.
Yes, right. That's correct. So tell me, what's happening in your business? I know you do a lot of business in Southern California as well as other places around the country. Tell us how your business is and what's happening.
Well, actually, I recently signed on purchasing some leads and stuff, and I'm finding that about a month ago, it's a lot of people are interested. They're looking, they're going on these websites, they're looking at properties, and then they're hitting them, and then they come to me, and they're definitely screened to a certain point. But a lot of people are definitely looking. They're realizing the rates are here. This is where they're at. In all actuality, they're really not that bad when you think about years in the past, how bad they were, double digits.
I agree. Yeah, I agree.
So it's just a matter of them getting used to the fact that these rates are here to stay, and who knows how long, we really don't, but you just can't. I personally would rather have gotten a cheaper price home now than I would have last year or the year before with the frenzy and the lower rates. You can always get rid of that higher rate.
Right.
But you can't always get that lower price on that property.
Well, that's true. I mean, obviously, if you're going to buy, it really comes down to supply and demand. If something is killing demand, i.e. either inflation or whatever the Fed's trying to do, that would give us more housing. But that's not really what's happening.
No.
So what's the answer here? I mean, in my own mind, obviously, we need more housing built, but that's not happening. So
no, it's not. It's kind of like I think it's on a freeze. I do think, though, I call on the average of 4 to 6 leads a day, and it seems like it's not that much. I can call a lot more, but it's a constant battle getting these people to realize, okay, this is what it is, and they're looking, but at the same time, they're getting hit with me as their preferred lender and assigned to that, but also they're getting assigned with a realtor involved. And so what's happening is a lot of these clients, which is really frustrating for me, is that it's a live lead. So the agent's getting it first, and then 2 minutes later, I get it. And there's very slim times that maybe one time I can beat them to the punch. It must be their they have to press a certain button to gain that lead. So they get it and they call, and I find it amazing that there's agents out there that are showing these borrowers or clients property before they've even had a prequal. I mean, you're wasting everyone's time. Let's see what they can do, and they can maybe do more than what they said on the lead.
Okay, so process. Let's talk a little bit about that, because I think that's valuable information for anybody who's listening to the show who actually goes on any of these sites, whether it's Trujillo or Realtor.com or Zillow, any of these sort of aggregate sites where you view properties that say, hey, do you need an agent? Hey, do you need a mortgage professional? What is the process that you think would benefit the borrower more if they came to you first? And what are the 5 or 6 things that you would tell them you need in order to give them some assurance that they could borrow a certain amount of money?
Well, that's a loaded question, but I will tell you the biggest beef that I'm having, and let me tell you, I am telling my account manager about this. I am paying a lot of money to get these leads. They're assigned only to me. They're putting me with these people, and I do believe what needs to be done, first and foremost, is to put on that lead to those agents. They have a certain format. I have a certain format with the platform, and they really need to put right up top, this is your lender, this is who assigned to it, because they don't look at and scroll down immediately. Their thing is just, I got a phone number, I got a name, I'm calling. So by the time they've called, I'm 2-3 minutes behind. They've already talked to them, and they've already said, well, we'll go ahead and go with, we'll refer you a lender or whatever. But they don't bother to scroll down. So I think what needs to be done, I wish it could happen, and I asked about it, but it's not going to happen. It's a live lead, so it needs to go to the agent first. But in reality, it really needs to go to the lender first, because these borrowers are just, the thing is if the agent's talking to them and they get to them first before I do, and I'm assigned to lead, and I've been successful with wrapping in a few, but the thing is if the agents would realize I'm actually a benefit for them, because if they tell that client to go and get pre-approved with a lender, chances are they're going to lose them, because they just don't want to be bothered. They want to have it instant gratification like now. So if they would maybe look at that lead and see, oh, Maggie Miller's on it, let's conference her in.
That's a great idea. Yeah, a team approach, even though you don't know each other on the team, but the borrower would feel rest assured that, okay, I have a couple of people working for me right now. That's a good thing, I agree with that particular approach.
And the whole reason for me going into this, Jeff, and I'm saying this because it's been something that I wanted the ability to meet more agents rather than just cold call them. I wanted the ability to let them know that, hey, I'm here.
Right.
I'm here to help. There's actually 4 of them. I actually pre-qualified these people right in the car.
Okay.
Over the phone.
Okay.
And that's really important, because otherwise the borrowers just go, well, I don't want to be bothered with all this stuff. And I tell them, listen, we'll go over this real quick. You send me the particular items that I need, but for right now, let's just go ahead and get you so you can get into a property and see them. Because a lot of people, they're not able to get into these properties unless they have a pre-qual. And I'm not going to just let them go in blindly. They have to give me something in order to send it to the agent and get to the agent. Yeah,
I do.
Yeah, a lot of people are looky-looing, and they want to see properties, and they're probably getting a little frustrated because they can't just go and see the property. The agents are like, okay, well, you need to get pre-approved.
Right.
And I'm all over it. I mean, I am. I'm really all over it, Jeff.
So the trouble with these types of approaches towards any business is that the model itself is really not designed to aid the borrower 100%. It's designed to really help out whoever's providing the lead. And so if there was this team approach, the borrower would be more happy, because as much as I tell borrowers, you need to shop around, you need to look around, you need to investigate, see they're not going to do it. The first person in the door is 90% chance they're going to be the person they're going to talk to. But that person, do they really know the loan business? I mean, to get these leads, you have to be approved. You have to have your own qualifications for the company that you're buying the leads from, so that they know that you're a qualified person to talk to people about loans.
They background you and screen you and make sure you got your NMLS and your license and all that. The biggest beef with me on these leads is that the agents, in my opinion, get more I don't want to say, to me, I feel like they're treated a little bit better than us as a lender, and that's not fair because we as a lender are paying for those up front. The agents don't pay for them until they close.
Right.
So there's no skin off their back. There's a lot of skin off my back, and I got to make sure these are working, so don't pass it off to someone else. So fortunately, I am the only lender on these, unless they go outside of my platform that I'm using. But I'm in their face within like a minute or two. And then I follow up with a text and an email. Then I call the agent, and then I follow up again and again.
Maggie, we've run out of time. I'm sorry, but I want people who can contact you directly to do so. How do they do that?
You can reach me at area code 805-527-5877.
Excellent. That's Maggie Miller from Malibu Funding. Maggie, thanks for coming on. I really appreciate it.
Thank you, Jeff.
Yeah, thank you. And I'm Jeff Barton, your voice in the mortgage industry. We'll be right back.
You're listening to The Mortgage Voice with Jeff Barton. We'll be right back with more in just a moment. For more information on today's topic, email Jeff Barton at info@malibufunding.net. Now, back to The Mortgage Voice with your host, Jeff Barton.
Welcome back, everybody. I'm Jeff Barton, your voice in the mortgage industry. Thanks very much for tuning into the show, for listening to us on a weekly basis, bringing you information that you can use, and new information that you may not have. Now, obviously, everybody knows what's happening in the mortgage industry in terms of rates, but do you know about programs? Do you know about the different ways that you might be able to finance? Do you know about terms and limits and the different down payment assistance programs? There's a lot of things out there that you may or may not know, and we're trying to bring that to you. If you want to hear and see the show each and every day, you can go to themortgagevoice.com or go to YouTube, Jeff Barton, The Mortgage Voice. Hundreds of shows there. You can see what's happened in the past as well as the latest and greatest, which is this week's, which will be on the radio on Saturday and Sunday, KCAA in the Inland Empire. Joining me, we always bring experts, people that really know what's going on, been in the industry a long time. If you're still in the industry now, you're an old-timer because you're once again going through rough times. Chris Calderon from Forward Mortgage joins us. Chris, how are you?
Doing excellent. Thank you for asking.
Thank you, and thanks for coming on the show. Okay, you see the market. You got your nose to the grindstone, your ear to the ground, whatever they say. Tell us what is happening in terms of both products that are addressing whatever it is that we call this market and the availability of funds.
So here's what we're seeing right now. Obviously, we're seeing a lot of down payment assistance programs.
Yep.
I know there was that program that was, existed for like 2 weeks in the month of March or April.
2 days, not 2 weeks. That was so fast, that down payment giveaway. That was awesome.
Correct. So, but there still are some products that are available. Like we have a really good FHA down payment assistance program, and it's not funded by any state. It's our own proprietary product. You see that. That's really good. Another thing that you're seeing right now is obviously, Fannie Mae made those adjustments to the LLPAs, I want to say about a month ago, 2 months ago. And so what you're seeing with that, it's affecting a lot of investment properties.
Okay.
So people that are looking to purchase a non-owner property or refinance a non-owner property. And what we're seeing now is the pricing has bumped up so much that just going non-QM on a non-owner occupied purchase or refi seems to be almost a better solution. You're not worried about, your DU passing.
Right.
You could do repay to lower the rate. So those are kind of some of the things that we're seeing right now. Another thing that I'm seeing right now is just, because the inventory shrunk so much, you're kind of seeing a bidding war, right?
Yep.
Now, you figure this, 50% of the United States has an interest rate of 3% or lower. 66% is at 4% or lower. So right now, inventory is just really, really tied up, right? And it's going to be like that for a while, especially here in California, where the market is always a little bit different than the national market. So, it's tough stuff. It's a little competitive. You're seeing lenders kind of pull back a bit. So, it's obviously crucial to align yourself with brokers that kind of are a little bit more flexible.
Yeah, I like that. And you had mentioned the market in terms of what lenders are doing. We've seen mergers and acquisitions, banks going out of business, that type of environment. What does a lender have to look? What does a borrower have to look for when they're looking at somebody to do business with?
I think what they need to look for, especially right now with lenders as they start to tighten up guidelines, with the credit crunch.
Yep.
I think they just need to find, a lender that just has solutions and just has more options available to them. Unfortunately, it's not a one-size-fits-all process right now. And, obviously, there's a lot of buyers that are maybe kind of locked up. They don't want to refi or purchase, but there's still some buyers that want to get into the market and maybe their credit isn't as good as maybe they, a traditional lender would like, or maybe their income has a few more twists and turns than a traditional lender would like. So, you just really kind of be aligned with someone that has options and also realizes that borrowers don't live their lives to mortgage underwriting guidelines. So you need someone almost like a sympathetic shoulder, if you will.
No, I like that, and the reason is because obviously in the non-QM world or non-traditional, I guess, loan world, offering more solutions with less documentation is the way I like to look at it.
Correct.
And in that, you provide obviously some solutions for people who are still able to pay the interest rate wherever it is. What's the old saying? You buy the house, you date the rate, something like that?
Correct.
Right. So go ahead. I'm sorry.
Go ahead. Yeah. So you are seeing some of that, and some of these non-QM loans, right? They still ask for a solid amount of documentation to verify that the borrower makes the payment. Obviously nobody wants a repeat of 07, 08, and those days of risky loans are far behind us.
Yep.
So yeah, it's just an alternative to help out borrowers that maybe they don't claim enough on their tax returns, but yet they're still making a boatload of money.
No, I think that's right. And I think for those particular borrowers, it's still a pretty good market because they're not as rate conscious as, let's say, your first-time home buyer who's got, visions of buying in a certain area and they want to do that with their new family they're trying to start. The first-time home buyer market I have not really seen as existent really over the last 12 months because of the rates the way they are.
Correct.
They're just backing off. So what happens is the rental market becomes overly heated, even though we've seen rent prices decline from COVID. But still, in my opinion, they're high, and I think a lot of the investment that's out there right now that are building units are building rental units. They're not building single-family units.
Correct. So right now you are seeing rents starting to decline a little bit, but it's still marginal. And compared to where it was pre-COVID,
right.
They're still really, really high. So, you have a lot of people that are kind of like, well, rates are high. And, the perfect response is your rent is high.
Right.
Right. And, you could always have the option as a homeowner, even if you buy a house with a higher interest rate, when rates drop, which inevitably they will, I wish I could say when and where so everyone could be geared up, but eventually that'll happen. But when it comes to when it comes to rent, your rent's never going to go down. If you're paying $3,000 in rent today, your landlord a year from now could say, hey, I'm raising it $150.
Right.
And then the next year they could say, I'm raising it $150 and so forth and so forth. So really there is no perfect time to buy. That's a question I get asked a lot.
Mm-hmm.
If I'm out to lunch or,
right.
if I'm at the gym, what do you do? When's the perfect time to buy? There really is no perfect time to buy. Is when do you as the individual think it's the perfect time to buy? And even though rates are high, because rents are still so high, if you could afford it, jump in the loan, and like you said, Jeff, date the rate. You could always refi and lower that payment if you want. You can't do that when you're renting.
No, and that's a great analysis because renters are stuck, and the rent is only going up, and that was a perfect way to look at it. $150 a year. Well, after 10 years, that's $1,500. So, that's a big number. If you're at $3,000, now you're at $4,500 10 years later or thereabouts. No, if you have a 360-month payment, you have the same payment the first month as you do the last month. And that's
Correct.
A way that you can plan for your future.
Correct. And again, you could always drop it. Whereas rent,
Right,
and again,
right.
that number that I'm saying 150, if that landlord wanted to raise it 250, 350, he or she's entitled to do that, and you got one option. Pay the higher rent or hire some moving trucks and
Right.
and get a new address.
Yeah, I agree. I always think purchasing is the best. To answer their question, when's the best time to buy? Well, really, you have to look at, is it the best time now to buy for you? Can you afford the payment that we're quoting you? Then now's the best time. Because
Correct.
Tomorrow's unpredictable. But once you own, you have a steady monthly and you really understand that you can always reduce your payments, you can put an ADR on your property and rent it out. You can do a lot of things when you own a piece of property.
Yeah, one thing I always talk about, right, and I always talk about generational wealth, and I'm sure there's some people out here listening, and maybe their parents, right, they didn't own a home, and this borrower is now in the position to maybe make that move. You're going to pass down that real estate to your kids and their kids and so forth. And maybe after you buy that house and you've owned it for a few years and you get some equity, right, you take out some of that money and you buy an investment property, right, and then you continue to let it build that way. It will never happen if you rent. You will never build anything. And the only thing that you're going to give your kids is the idea that renting and never owning something is the best idea, and we all know that's just not the case.
It isn't. Chris, we're at the end of it. Could you let people know how they can get in touch with you over at Forward?
Yeah, you can always use my cell phone. That's the best number to reach me at, area code 818-926-7078. Once again, 818-926-7078. Or you could email me at ccalderon, that's CCALDERON, at forwardlendingmtg, M as in Mary, T as in Tom, G as in Greg.com.
Chris, thanks very much for coming on. Always appreciate the information. Really good talking to you again.
Likewise, Jeff. I'll talk to you soon.
Talk to you soon. That's Chris Calderon from Forward Mortgage. I'm Jeff Barton, your voice in the mortgage industry. We'll be right back.
You're listening to The Mortgage Voice with Jeff Barton. We'll be right back with more in just a moment. For more information on today's topic, email Jeff Barton at info@malibufunding.net. Now, back to The Mortgage Voice with your host, Jeff Barton.
Welcome back, everybody. I'm Jeff Barton, your voice in the mortgage industry. Thanks very much for tuning into the show, for listening each and every week. You know, you can hear and see this show in many, many different places. One of the places that you can hear it again and again is on the number of podcasts that we're on. Now, we're on a number of different podcasts. You can go to KCAA and get their list, but certainly we have our list. Do you have that for us, Darryl?
Yeah, I'm going to need Phil for me for like
no
10
problem
seconds.
at all. And one of the great places that we go for our centralized version of it is podclips.io. Podclips.io is a great place which you can centralize, as I said, the podcasting wants and needs that you have, whether it be health or lifestyle or finance, which is what this program is, sports, any number of other different avenues. Great place. Go to one place, get all your podcasting needs, podclips.io.
Aside from that, there's Apple Podcasts, Spotify, Spreaker, Stitcher, iHeartMedia, Radio.com, YouTube, and you've mentioned podclips.io, and of course, themortgagevoice.com.
Excellent. And as I said earlier, you can go to themortgagevoice.com, or you can go to YouTube, Jeff Barton, The Mortgage Voice. These are all great places to see and hear the show. If you cannot tune in each and every week on Saturday and Sunday as you're cruising around, either going to Home Depot or to church or wherever it is that you're spending your time on those particular days. Again, I'm Jeff Barton. This is The Mortgage Voice, and thanks for tuning in. Okay, home prices, I said earlier in the show, have increased month to month and year over year, have really remained unchanged or really gone down a little bit. The medium, this is an interesting. People often talk about the lack of housing in Southern California, and there is certainly a lack of housing. I know a lot of the housing being built is being built for renting, not necessarily for single-family owners. But you ever think about the people who actually do the building? Like, what are these people? Who are the people, the gangs, the crews, all the people invested in that part of the industry, which really makes everything work? We need more houses. We need somebody to build them. So one of the things that they had a chart up, I read the other day, about the age of workers and the different construction jobs that are out there and the age of the worker who is actually doing these jobs. Because as everyone knows, there's a thing called quiet quitting that they talked about in the white collar and the high-tech world, whereby people just stop working. And they're not necessarily, quitting one job and going to the next job. They just don't show up, and that's it. That's called quiet quitting. Well, certain age groups also retire, like 65 to 75 years old. You're going to find most of your working population in that group are going to retire within that 10 years period. It's just what it happens. Now, in the construction worker world, most of the workers are actually older than you might think. So here it is. The median age of construction worker, the median age, that means the line in the middle, half is above, half is below, is 40 years old. Now, that seems old to me. Why does that seem old to me? Because I would think that especially you think of construction, right? Obviously, you've got framers and you've got cement people, you've got electricians, you've got a whole host of different people who are in that particular field. And being that we're in Southern California, a lot of our labor is unskilled. Certainly there are many that are skilled, but of the labor, and you think about whether it's in agriculture, whether it's in construction, or whether it's in any number of other jobs that require huge amounts of labor. So I'm thinking, well, can old people do that job? I mean, I don't think 40's old, but it's certainly old for lifting 100-pound bags and lumber and all that. No, 40 years old. And what's even more striking is skilled labor in construction sites are actually 50 and above. So the construction company contractor, the electrician, the plumber, the cement people, they're all older. So what happens when this pool of workers decides, I've had enough? We already have a problem in Southern California with not enough housing. What happens when the actual people building the houses are aged out? They just had enough. Because that's tough on your body. I don't know about your job. My job, obviously, I'm talking in front of a microphone. No, unless I get a sore throat, it's not that taxing on my body. But you know the way the summers are here, even the winters. It's harsh climate out there. It's dry. It's tough on your skin. It's tough on, I mean, you go by any construction site anywhere, Southern California, you'll see people with hats on or long sleeves, you know, just very burly people out there doing that kind of work. Anyway, I just thought that was interesting, and I bring that to you. Jobs report was out last Friday, and since I just got to the microphone today, 339,000 jobs are added. The unemployment rate is 3.7%. The unemployment rate actually went up. Now, it's interesting. Unemployment rate goes up, but the jobs that they're creating, 339,000 jobs, is really amazing. They had thought because of the cooling of the economy is indicated by the GDP being between 1 and 2 rather than 2 and 3. So that tells you that, okay, so there's less commerce going on in America. And the other one, of course, being that, what am I trying to say here? Jobs being added, unemployment rate at 3.7%. Yeah, okay, so the mortgage rates weaken demand. That's what I'm trying to say. So when in fact you have mortgage rates at a certain number, let's say the mortgage rate is at, I don't know, 6.5%, 7%, it's going to weaken the demand of housing. Weakening demand of housing affects everybody in our industry. Now, we just talked about why other examples of what's happening in the housing industry is going to affect you and your decision. If you have scarcity of housing, that's one thing on demand. But if you have weakening demand because of raising of the interest rates, that's another reason why housing doesn't get built. And these things, the reasons why housing doesn't get built is a big deal, and a big deal to people who need the housing. So the rental market being what it is, and also being the most heavily invested in terms of construction in Southern California, companies are building units to rent. They're not building homes to sell. That's the difference between what's happening in this particular recession. We all know that there's demand there, so for companies that are looking at demand in Southern California for housing, they're doing it in terms of not allowing you to buy into it, build wealth via the raising or escalating prices over the term of the loan, which is usually 30 years, right, 20 years. You're going to see your house price increase and your loan payments stay the same. So therefore, that's a good deal in how most people get wealthy in America. Okay. When will mortgage rates drop? Article out in Yahoo today from CBS News. A couple things. Okay. 10 consecutive rate hikes by the Federal Reserve taking a toll on the housing market. Well, I just talked about that, right? Raising interest rates kill demand. So what are they saying about whether demand itself, whether mortgage interest rates itself will fall? What does it say here? The median home price in the U.S. is $388,800. And that's a drop, by the way. It says over the past year, home sales fell 23%. Home sales fell 23%. The only reason home sales are falling is because you have higher interest rates and you don't have new product on the market. The entire show, we're talking about product on the market, the availability of housing, mortgage interest rates, and how they're all tied together. So that when you see perhaps the Fed is going to be able to ease their interest rates. Now, everybody knows that the Fed rate is not the mortgage rate. They are symbiotically connected, but they are not the same. If, in fact, people feel that the Fed will stop charging more money, then they will spend more money. Spending more money means building more houses. Building more houses means you have an opportunity to get out there into the marketplace, and prices should drop if we have more supply. Supply and demand says you have more supply than demand, prices drop. That's what we need, although we haven't had that in 10 to 15 years. That's why we have prices the way they are today. Another thing here, let's see what it is. I got one other little thing in this particular, okay, here it is. The Mortgage Bankers Association forecasts that the average on the 30-year fixed-rate mortgage will decline throughout 2023, continuing to the first quarter of 2024. Now, I've been saying this as well, although I have zero to back it up other than I think they're too high, and yes, I'm hoping they will do that, especially if the Fed, as I say, stops their own particular interest rate hike, which I think by the end of the year. I don't know if they're ready to do that because inflation is still at 4.7. They want it at 2%, and they're going to beat the heck out of the economy until it gets there. Problem is, job growth and GDP are still pretty strong in terms of these 10 consecutive rate hikes. Anyway, I'm Jeff Barton. I'm your voice in the mortgage industry. Really appreciate you listening to the show. There's a lot to consider when you're out there buying. Make sure you give us a call if you need some help. Thank you very much, and we'll see you next time.
You're listening to The Mortgage Voice with Jeff Barton. For more on today's topic, visit www.malibufunding.net.
KCAA, where every day is a great day.
The message your brother Stair